Hello and welcome back to my channel Brosnomics. We are still in a lockdown, but one other thing is also in lockdown, and that's our property market. And with that, the withdrawal of some of the increasingly attractive mortgage deals that we see around. If you checked out my other video, how low can you go, lowest interest rate ever we've seen in history, in this video I want to talk about how that low interest rate actually translates into some of the increasingly attractive mortgage deals that are offered by banks. But that's not entirely good news, because at the same time they are also restricting the lending criteria and in some cases withdrawing those products altogether. House prices, we're expecting a drop of 5% or thereabout, but nowhere as near as we've seen in 2008-9, for one very simple reason. Banks have more liquidity now, and I'll get into a bit more detail on that one. But I just want to show you a quick example with mortgage and low interest rate. Let's take this product offered by HSBC, for example, and take the median UK property price of, well, it's about £230,000. We'll make it £240,000 for this example. Let's say we have a deposit of £40,000, so we're borrowing 200,000 together to make up to the 240,000 purchase price. Now, if I take a 2-year fixed, 85% max loan to value ratio, fee saver, term is not entirely important. I'll make another video on mortgage products, but it has to be residential. And the interest rate back in October 2019 was 1.99%. Now today, I'm just checking this, that interest rate has actually come down to 1.84%. Now, that's a drop of about 0.15%. What does this actually mean? Let's say we borrow 200,000. The first year of interest charged would be 200,000 times 1.99 before. Now, that's only the first year of interest charged, not the capital repayment. So your mortgage repayment consists of the capital repayment as well as the interest charged. That for the first year would have been £4,000, just under. Now, with the lower interest rate of 1.84, let me just put that in, 184, 200,000, 184, it's actually come down to £3,700. So that's a reduction of £300, which is quite good if you're a first time buyer and are able to get onto one of those products now compared to 6 months ago. However, there's a big if you can get on one of those products, because banks are already experiencing an increasing number of calls from existing customers trying to get a mortgage payment holiday because they are either anticipating or are experiencing financial difficulties themselves. Now, because of that, banks are reluctant to take on new customers for their loan book. So what you have is you might need to have a higher pre-tax salary to start with to borrow the same amount as before. That's a lower income multiple. But then secondly, you also might need to have a higher deposit in order to access those mortgage products. So banks are essentially saying, for some of our products, you can't get onto the 85% maximum loan to value deals anymore. So that's not entirely good news. But the other piece of good news is house prices. It will come down a little bit. Expecting about 5% this year before coming back up in 2021. But it's nowhere as near as we've seen in 2008-9 for one very simple reason, and that's because banks have more liquidity this time round. In 2008-9, we didn't have the macroprudential policy framework that asks banks to have a certain capital buffer in case exactly what's happening now, that customers are asking banks, or can you give me a bank holiday, a payment holiday, in order to smooth out the financial difficulty that they are experiencing. And what that's doing is bank, instead of repossessing the properties, can actually forbear, is the term, their customers for a period of time. But back in 2008-9, they were repossessing these properties really quickly, and because they were lacking cash, they were trying to sell these properties back onto the market really quickly as well. And when you want to sell them quickly, you had to sell them cheaply, and because of that, essentially, you're having lots of these sellers, banks, going for a below market price. That's causing a huge crash in house prices 10, 11 years ago, and that's not happening now. So 5% is quite reasonable. So let's do a summary here. It's quite good news if you look at the low interest rate combined with a possible reduction in house prices. Quite reasonable, quite modest, 5% or so this year. But you need to have one, possibly higher pre-tax salary to borrow the same amount of money, and two, you might need to have a bigger deposit to access some of these mortgage deals. So that's what the current housing market lockdown is impacting on you. Low interest rate, great. Lower prices, good. But banks are also withdrawing some of these deals, so it's harder for first-time buyers to get on the property ladder. Thank you so much, guys, for all your comments, feedback. Really appreciate them. If you like this video, please like and subscribe to my channel, Borasnomics. Look forward to seeing you in my next video. Bye.